In October 2008 the British government reached for its anti-terrorism legislation and used it to freeze the assets of a bank belonging to a NATO ally. A country with no army, no navy and no air force. For a while, an Icelandic bank sat on the United Kingdom Treasury's sanctions page in the same list as terrorist organizations. 2 days before that, on the 6th of October, the Prime Minister of Iceland went on national television. He told a population of roughly 320,000 people that there was a real danger the national economy would be sucked into the whirlpool with the banks, and that the result could be national bankruptcy. Then he ended the address with 4 words Icelanders have not forgotten since. God bless Iceland. It is not a phrase Icelandic politicians use. Within 3 days of him saying it, all 3 of the country's major banks had been taken over by the state. Those 3 banks had grown to roughly 10 times the size of the entire Icelandic economy. And what happened next is the reason this file exists, because Iceland is the case everybody thinks they know. You have probably heard that Iceland let its banks fail, refused to pay, and jailed its bankers. 2 of those 3 things are true. The third one is not, and the real version is stranger. This is the collapse of the Icelandic banking system, the fastest and, relative to the size of the country, the largest banking failure in recorded history. 3 banks, 3 days, and a nation of 320,000 people left holding a balance sheet the size of a continent. To understand the size of the fall you have to understand how small the country is. Iceland is an island in the North Atlantic with a population smaller than a mid-sized city. For most of its modern history its economy was fish, aluminium smelting and, increasingly, tourism. It was prosperous, it was stable, and it was profoundly ordinary. Then, over about 5 years starting in 2003, the country's banks were fully privatized and something extraordinary happened. A generation of young Icelandic financiers took institutions that had mostly lent to fishing companies and turned them into international investment banks. They were not restrained by anyone, in part because there was almost nobody in the country with the experience to know what restraint would look like. Their growth model was borrowing. Icelandic interest rates were high, which meant foreign money wanted in, and international credit in the mid-2000s was effectively free. So the banks borrowed enormously in foreign currencies, lent it out, and expanded. Between 2003 and 2008 their combined assets went from roughly the size of the Icelandic economy to roughly 10 times it. The money went shopping, and Britain is where the shopping was most visible. Icelandic-linked investors bought stakes in well-known British high street chains, toy shops, department stores, food companies, a football club. The British press called it a reverse Viking invasion and mostly found it charming. Nobody asked the obvious question out loud: where does a country of 300,000 people get the money to buy the British high street? Inside the banks, the structure was less charming. Later investigations found extensive cross-ownership between the banks and their largest shareholders, and lending by the banks to those shareholders to buy shares in the banks themselves. If you lend a man money to buy your own stock, you have not raised capital. You have created the appearance of it, and taken on the risk of both sides of the trade. But wholesale borrowing has a weakness: it can vanish overnight. So the banks went looking for something stickier: ordinary savers. In 2006 Landsbanki launched an online savings account in Britain called Icesave, and in 2008 in the Netherlands. It paid better interest than the high street banks, it was simple to open, and it was covered by a deposit guarantee scheme. More than 300,000 British savers put money into it, a number roughly equal to the entire population of Iceland. Local councils put money in. Charities put money in. Police authorities put money in. And this is the detail that makes the later argument so bitter: the guarantee scheme standing behind those deposits was Icelandic, and it was tiny relative to the sums involved. Warnings existed. In 2006, analysts at a Danish bank published a report arguing that Iceland's expansion was unsustainable and that the country was heading for a hard landing. Icelandic officials and bankers reacted furiously, treating it as an attack on the nation rather than an argument about balance sheets. The market wobbled, the banks raised more funding, and the episode was filed away as a scare that had passed. Here is the structural problem underneath all of it, and it is the one that actually killed them. A central bank can rescue a banking system by creating money, but only in its own currency. Iceland's banks had borrowed in euros, pounds, and dollars. The Central Bank of Iceland could print krona all day and it would not have bought a single euro of the debt coming due. The lender of last resort had the wrong currency. In September 2008, after Lehman Brothers failed, the wholesale funding market that Icelandic banks depended on simply closed. On the 29th of September, the government announced it would take a 75% stake in Glitnir, the smallest of the three, to save it. It was meant as a rescue. It was read as a confession. The credit rating agencies downgraded the country within days. Foreign banks stopped rolling over Icelandic debt entirely. The krona became almost impossible to trade, importers could not reliably buy the foreign currency they needed to pay for goods, and an island that imports most of what it consumes suddenly could not settle its bills abroad. And then came the 6th of October, and the speech. What the parliament passed that same day was not a bailout, it was an emergency law that did something more surgical. It gave the regulator power to seize the banks, split them in two, and put the domestic Icelandic operations into new banks that would keep working. Critically, it also made deposits a priority claim, ahead of the bank's other unsecured creditors. For people living there, those days were physical rather than financial. Icelanders traveling abroad found their cards declined at hotel desks and petrol stations. Importers could not open letters of credit. Businesses that had ordered stock months earlier discovered they had no way to pay for it. A modern European country briefly lost the ability to transact with the outside world, and it happened inside about a week. Read what that means carefully, because this is the decision the whole legend is built on. Iceland did not put taxpayers behind the foreign liabilities of its banks. It protected the domestic payment system, the cash machines, the salaries, the savings of people living in Iceland, and it let the international side collapse into administration. Landsbanki on the 7th. Glitnir on the 8th. Kaupthing on the 9th. Which brings us back to the hook. On the 8th of October, with Icesave frozen and 300,000 British savers locked out of their money, the British government acted to secure Landsbanki's assets in the United Kingdom. The legal instrument it reached for was the Anti-Terrorism, Crime and Security Act of 2001. It is worth being precise, because the precision makes it worse rather than better. The section used was not the terrorism section. It was a provision covering action by a foreign government considered detrimental to the British economy. Legally, Britain did not call Iceland a terrorist state. But the statute was called the Anti-Terrorism Act, and the listing appeared on a government page alongside genuine terrorist organizations. In Iceland, the distinction did not land. Icelanders responded in a way that tells you how deep it went. Ordinary people photographed themselves holding signs saying they were not terrorists, and put the pictures online in their thousands. A country that had spent 5 years being told it was a financial superpower discovered, in a single week, exactly how much weight it actually carried. The cost inside Iceland was severe, and this is the part usually missing from the triumphant version. The krona lost roughly half its value. Inflation went above 18%. Unemployment rose from around 1% to around 9%. In November the country took an emergency loan from the International Monetary Fund, the first Western European country to need one since Britain in 1976. And Iceland had a particular cruelty built into its mortgage system. Many Icelandic home loans are indexed to inflation, which means that when prices rise, the amount you owe rises with them. So the same collapse that destroyed people's incomes also mechanically increased the principal on their houses. Others held loans linked to foreign currencies, which doubled in krona terms almost overnight. Iceland also imposed capital controls, restrictions on moving money out of the country, in November 2008. They were meant to be temporary. They lasted until 2017. For nearly 9 years, an advanced European democracy operated with its citizens' money locked inside its own borders. That is a real cost, and it is one nobody mentions when they hold Iceland up as the country that got away with it. The public response arrived in the street. Through the winter, protesters gathered outside the parliament building in Reykjavik banging saucepans, pots and kitchen utensils, a noise that carried through the old town center until it became impossible for the people inside to ignore. Icelanders call it the pots and pans revolution. In January 2009 the government fell. Not through a coup, and not through a crisis of the constitution, but through several weeks of ordinary people making noise outside a building until the arrangement inside it became untenable. New elections followed. This is the first thing Iceland did that almost nobody else did: it changed the people in charge. Outside Iceland the damage had a very specific shape. Because Icesave had paid better rates than the high street, the institutions that had chased those rates were often the ones with a duty to be careful with other people's money. British local authorities alone had put close to £1 billion into Icelandic banks. Charities, universities and police pension funds were caught too. The lesson those bodies learned is the oldest one in this series: a higher rate is not a gift, it is a price being charged for a risk somebody has decided not to explain. The second thing was the report. Parliament appointed a special investigation commission with real powers, and in April 2010 it delivered around 2,300 pages across 9 volumes. It named names. It found gross negligence by specific ministers and regulators. And then something happened that has no equivalent anywhere else in this series: people queued at bookshops to buy it, and a public reading of the report was broadcast. The third thing was the prosecutor, and the story of how he was appointed is almost comic. The government advertised for a special prosecutor to investigate the collapse. The first advertisement produced no applicants at all. On the second attempt one man applied, a district magistrate from a small rural community in the east, with no background in complex financial crime. He got the job, and then he built a team of more than 100 people. Over the following years that office secured convictions against roughly 26 bankers, including chief executives and chairmen of the collapsed banks, with combined sentences running to several decades. The charges were things like market manipulation, breach of fiduciary duty and fraud, the same conduct alleged in a dozen other countries after 2008, and prosecuted in almost none of them. There is also the case of the Prime Minister, and it has to be described accurately because it is constantly reported wrong. Gerhard was brought before a special constitutional court, the only time in Icelandic history it has ever sat. He was acquitted of the 3 serious charges. He was convicted on one minor count, for failing to hold cabinet meetings on important matters, and no punishment was imposed. He did not go to prison. Now the part that everybody gets wrong. The popular version says Iceland refused to pay its debts. It did not. What actually happened is more specific, and more interesting. The Icelandic state declined to guarantee the foreign deposits with taxpayer money, and that question went to the voters, twice. In March 2010 a referendum on the repayment terms was rejected by about 93% of those who voted. A renegotiated deal was put to a second referendum in April 2011 and rejected again. Britain and the Netherlands took the dispute to the EFTA court. In January 2013 that court ruled that Iceland had not breached its obligations, and was not required to guarantee those deposits. But here is the sentence that gets left out. The British and Dutch governments had already repaid their own savers, and then claimed against what was left of Landsbanki. Because the emergency law had made deposits a priority claim, those claims sat at the front of the queue. By early 2016 the estate had repaid the priority claims in full. The money did come back. It simply did not come from Icelandic taxpayers. Iceland returned to growth in 2011, faster than most forecasters expected. The collapse of the krona made the country extraordinarily cheap to visit, and tourism went from a niche industry to the largest export sector in about a decade. Unemployment came back down. The capital controls were finally lifted in 2017, 9 years after they were imposed. So what did Iceland actually do differently? 3 things, and none of them is the thing people usually name. It let the international side of its banks fail while ring-fencing the domestic payment system. It investigated itself in public and published the result. And it prosecuted, patiently, for years, through an office that nobody wanted to lead. And then the uncomfortable question, why did nobody copy it? Part of the answer is that Iceland had no choice. Its banks were not too big to fail, they were too big to save. A state whose banking system is 10 times its economy cannot bail it out even if every politician in the country wants to. Ireland, whose banks were a smaller multiple, did guarantee them, and spent the next decade paying for it. The lesson of this file is not that small countries are wiser. It is that Iceland was forced into the honest version of a decision every other government in 2008 got to avoid. When you cannot afford to socialize the losses, you find out who was actually supposed to bear them, and the answer was always the people who lent the money, not the people who happened to live nearby. Everywhere else that question was settled quietly, in favor of the lenders, and the bill was handed to the public over the following decade. Iceland is not the country that escaped. It is the country that was too small to pretend. On this channel the ledger always comes due, and the next file is already open. Subscribe, and vote in the pinned comment for which empire falls after this one.